Hey, Jeff Carlisi here from 38 Special, and we're rocking it up right here with Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have back with us once again John Grace, founder and president of Investors Advantage Corp. John, welcome back to Traders Nation. How are you today?
I'm good, Kurt. Good to be back with you again.
Always a pleasure, John. Hey, listen, so the Fed, they're going to be holding rates right here, John. At least steady for now, right? But certainly, they're keeping the door open for possible future cuts, aren't they?
Oh, absolutely. They've got 4 more formal opportunities this year, so I didn't expect, I mean, you can always be surprised, right? Who knows who's going to be right until after it happens, but I would have been surprised had we seen a rate cut this soon. I think they're coming. Yeah. I think there will be several of them, and I don't think it has as much to do with the administration as it has to do with the Fed's intention and certainly their format of looking at things independently.
Sure. It's kind of hard to read the Fed, isn't it, when they have their meetings? You used to be able to look at Greenspan shoes and kind of have a good idea, right? What the outcome was going to come. Everyone's like looking at Greenspan shoes and like, okay, all right, we're okay. And then, oh, God, look what he's wearing. Maybe not so, but it's kind of hard to read the Fed anymore, isn't it?
Well, I think it should be, but I also submit that they're in a difficult place. On the one hand, these are people who work for the government, and when you work for the government, if I worked for the government, I'd have to be saying that everything's fine. Sure. So that's why I say we need to look for other sources, folks that aren't associated, for example, with underwriting stock, and those who are not part of the administration, to get a sense for what really is around the curve, as opposed to thinking we're going to get the straight and narrow from the people have absolutely have an agenda.
Right. So they're even as careful as their language in what their minutes say, isn't it? For instance, they dropped the word patient, describing their approach to policy. Can we read on that at all, or what's in there?
I think that's a sign that lower rates are in the cards. That there needs to be some action taken, as opposed to just kind of watching and wondering to see whether or not we're going to make a move. Now, I will say that I think those moves will occur, and yet because the overall economy, and I mean on a global basis, is slowing, they may have little to no effect. I mean, let's just look at Japan, where they've been negative for off and on for I don't know how long, and notice how there has not been any real growth to their GDP for years.
Yeah, exactly. So with the Feds leaving rates as they are, does that kind of set up maybe a confrontation with President Trump? As you know, he certainly would like to see those rates cut, but he's kind of poised on the sideline too, knowing that there's more potential possibilities down the road. So I don't know. Some are talking, well, this is setting up a confrontation. Others are saying, well, maybe not so just yet. Just hold on. What are your thoughts?
Well, it could be, but I look, people, you're either a president hater or a president lover. Well, why not just be an observer of things, okay? I don't like the label. So, I mean, what I notice is that my dear fellow Gemini, Donald John Trump, he likes taking care of himself and his friends, and I understand that, and he likes telling the public that he's taking care of them. Only when I talk to folks like David Stockman, by the way, he was OMB director under Reagan, right? Served in politics as a Republican. He sums it up like this: the top 1% since 1989 have gotten $21 trillion richer. The bottom 50% have gotten $900 billion poorer. And by the way, he says that's the legacy of Alan Greenspan and monetary central planning.
Right.
So we're all trying to say, hey, don't pay attention to the man behind the curtain. Just move along. Everything's fine. And when we really need to look at, as I say, is let's get other information, other sources to get a sense for are things really growing, or are we just trying to say they're growing? I submit that a better source tends to be the International Monetary Foundation Fund, and notice that every quarter they keep reducing their expectations as to growth. Slower growth is better than no growth, but it's continuing to slow worldwide, and it's easy for us to say we're the best and the brightest. I would say we're the best house in a bad neighborhood, and all the houses are attached. Okay, we're all in the same street, so we're in line.
Nice. So let's talk about all the members on the Fed, certainly, because my point is that you got 8 members that favor a cut this year, while the same number of votes favor the status quo, and I don't, and then there's one that wants a rate hike. Does this kind of indicate that maybe there's a divide in the Federal Reserve? Your thoughts there?
Well, I don't know that I'd call it a divide. It sounds like it might be a healthy conversation.
Sure.
When everybody decides that, this is the best of times or everything's just fine, that's when I get more worried. I actually prefer to see some option or, some opposite thinking from the standpoint of, well, this is how I think, well, this is how we think or you think.
Sure.
Well, okay, so what are we going to do from here?
Yeah.
I think that's a healthy conversation. I wish we did more of that.
Yeah, I agree. Maybe, I wonder if as a nation, if we could follow the example of the Fed and just kind of like say, we'd like to hear all points of view. Certainly, wouldn't that be more healthier as a society if we could just follow that example?
Oh, heck yes. I mean, we're all human. We really all want the same thing.
Yeah.
Let's come from that perspective and identify and prioritize what's important to us and have conversations as opposed to, well, I don't like you anymore, so I'm just going to throw you and everybody who looks like you under the bus.
Right. So we got four chances between now and the end of the year. Certainly, how's that going to have an effect on the economy, if at all, right?
Yeah. Well, I mean, like I say, they're going to use all the bullets in their chamber. It's just that this is probably the only bullet that they really have, and I am not sure that it's going to have the kind of impact that people are hoping that it does to further goose the economy, to further encourage individuals, companies, and governments. We're all doing the same thing, Kurt, at the same time, where debt levels are higher than they've ever been, and of course we recognize that in 2008 we didn't see that bus coming, right? Credit default swaps, what the heck is that? And little did we know the world as we knew it almost changed overnight. So I'm submitting that, interest rates are good. They're lower when it's nice when it's good, but sometimes, when we go out for credit, where it's not the best thing we should be doing, but it's easy to do, and that's what a lot of this growth has been around credit, both for the real estate market and the stock market, along with the corporate buybacks that I submit has been really the energy, if you will, behind these gains.
Yeah. So what about the argument of raising the rates to get it back up so at least the Fed has some maneuverability in the tools that they have as far as the economy is concerned? Dropping it down to 0% or down to these rates that we're seeing historically low. And they remain low. I mean, a decade ago, we were like, you're going to look to refinance your home, you better do it now because these rates aren't going to stay here forever. Boy, were we wrong. Right? Yeah. Because it's like, get it while the getting's good. But the getting kept getting good, and it's still here. So what about raising it up and putting tools back into the Fed?
Well, let's talk about that for a minute, because, see, here's the thing. Back in the early 80s, when boomers were standing in line around the country to buy a house, or whatever the price might be, interest rates might have been 12%, got as high as 18%, right? But let's just recognize it wasn't interest rates that were the primary driver, and this is the thing that I think is so fascinating. We're always looking at these little, ornaments that get our attention. We get all excited. That's not the driver. It's people. It's 76 million people coming into the equation with an education, a little bit of money, and a desire to buy a house. So let's just notice, you could not have told any boomer that 3-4% housing price money, loan money, was in their future. Nobody would have believed that. They would have asked you to step away from the conversation because clearly you are out of your mind. So let's just notice that's the best environment you never imagined, and yet nobody's really standing in line anymore to buy a house like they did. 76 million people are now 55 to 73. They're done with for the most part. They bought the first house at 31, the biggest house at 41. They sell their houses typically, according to the Census Bureau, around 79. So as I say, we can kind of make these things kind of glitter.
We're out of time.
They don't really drive us.
We're out of time. Stay tuned.
All right.